In this video, we'll see that wealth in the United States is surging at an extraordinary rate, but that credit growth is slowing sharply, and that much of the increase in credit that is occurring is the result of the rapid growth in government debt. Of course, a large increase in wealth is a good thing, but the ratio of wealth to income is alarmingly high and suggests that asset prices could fall sharply should any unexpected shock occur. Also of concern, weak credit growth is sending a warning signal that economic growth could slow rapidly during the quarters ahead, and the reliance on government debt as the main driver of credit growth, and therefore of economic growth, highlights the inability of the private sector to power the economy on its own. Overall, surging wealth, slowing credit growth, and an over-reliance on government debt paint a picture of an economy that is out of balance. Imbalances tend to eventually correct themselves, often in very painful ways. Investors need to be aware of these imbalances and consider how they would respond if they begin to come unwound. All the data in this presentation is from the financial accounts of the United States, unless otherwise indicated. First, wealth. Household wealth in the U.S. has surged to $164 trillion. This increased by $2.8 trillion during the past quarter, $10.8 trillion over the past year, and $47 trillion since the end of 2019. $47 trillion is enough to pay off all U.S. government debt, with $12 trillion left over. This huge increase in wealth has been one of the most important factors in driving strong economic growth in the U.S. in recent years. However, the wealth-to-income ratio, currently 785%, is far above its long-term average of around 550%. Earlier peaks of 620% in 2000 during the NASDAQ bubble and 680% in 2007 during the property bubble were followed by severe crashes. This suggests that any shock could send asset prices sharply lower. Should that occur, it's very likely that a recession would follow. Shocks could be caused by geopolitical developments, economic developments, like a resurgence of inflation, or even political developments within the United States. Investors should not ignore the possibility that shocks like these could bring about a substantial amount of wealth destruction. Now, credit. It's important to watch credit growth carefully because when dollars ceased to be backed by gold 5.5 decades ago, credit growth became the main driver of economic growth. And when credit growth is weak, the U.S. economy tends to go into recession. This chart shows credit growth and GDP growth, both adjusted for inflation, from 1952 to 2009. Credit growth is in red, GDP growth is in blue. Between 1952 and 2009, total credit adjusted for inflation grew by less than 2%, only 9 times. Every time that happened, the U.S. went into recession. The following slides will show that U.S. credit growth is now weak and getting weaker. As of mid-2024, total credit in the U.S. had increased to $99.8 trillion, a 100-fold increase in 60 years. Notice that the only time credit contracted in 2009, massive government intervention was required to prevent the U.S. from collapsing into a depression. Total credit is equal to total debt, or in other words, to the debt of all sectors of the economy combined. I use the terms total credit and total debt interchangeably. At the peak in the fourth quarter of 2020, total credit grew by